A woman in Kolkata just made 26 crore rupees selling stock, and the tax department got nothing. Not because she hid it, because she knew a rule almost no investor uses. Here's what actually happened. A Kolkata businesswoman sold 36 lakh shares of a well-known company. The sale value, 33.77 crore rupees. Her profit on that sale, 26.77 crore rupees. A profit like that would normally come with a very large tax bill. Let's quickly compare how this kind of profit gets taxed in India versus the US. In India, long-term gains on stock above a certain limit are taxed, currently at 12.5%. In the US, long-term capital gains are taxed at 0, 15, or 20% federal, depending on income. But here's the key difference. India has a special relief if you reinvest stock proceeds into a house. The US doesn't have a direct equivalent for that. That relief is called Section 54F. Here's how it works. If you sell a capital asset, like stock, and reinvest the proceeds into building or buying one residential house, you can claim a full exemption on the capital gain. The one condition: you must not already own more than one other residential house. So, here's what she did. She sold her shares for 33.77 crore, a gain of 26.77 crore. She invested 53.86 crore into constructing a residential property in Kolkata. The house was completed within the 3-year window the law allows, and she filed for a full exemption under Section 54F. The tax department did not accept it. They rejected her claim on 3 grounds. 1. They said she already owned other residential properties. 2. They said construction had started before the share sale. 3. They said the exact sale money wasn't directly used for construction. A senior tax appeals body agreed with the rejection and went even further, calling the whole transaction a, quote, colorable device. In plain English, a fake structure built only to dodge tax. Here's how she fought back. The first extra property the department pointed to was jointly owned with her family. But joint ownership is not the same as exclusive ownership under the law. Courts have already ruled that partial or joint ownership of a family home does not disqualify you from this exemption. The second property the department cited was actually industrial land with a factory on it. Industrial land is not a residential house, so it simply does not count against her under Section 54F. What about the timing? Section 54F never says when construction has to start. It only requires the house to be completed within 3 years of the sale. Her construction finished well within that window. And the money itself? The law does not require the literal rupee notes from the stock sale to be used. It only requires an equivalent amount to be invested in the house. She invested 53.86 crore, far more than the 26.77 crore gain itself. So, what did the tribunal decide? The case is Saroj Goenka versus the Income Tax Officer, Kolkata. The Income Tax Appellate Tribunal ruled completely in her favor. Every single objection from the tax department was overturned. The result? 0 tax on a 26.77 crore rupee stock profit. Completely legal. Now, is this a loophole? No. This is not tax evasion. Evasion means hiding income or lying. This is tax planning, using a rule exactly as it's written in the open with full disclosure. The tribunal's own reasoning was simple. A law shouldn't be read more narrowly just because the amount involved is large. Structuring your finances within the rules is not the same as cheating. Here's why this matters, even if you don't have 26 crore rupees. If you ever sell stock for a large long-term gain in India, reinvesting into a residential property can defer or even eliminate the tax on that gain. If you're investing from the U.S., there's no identical rule, but tools like tax loss harvesting and holding periods serve a similar purpose. The real lesson here isn't go buy real estate. It's know what reliefs exist before you sell. Let's make Section 54F simple. 1. You must not own more than one other residential house at the time of sale. 2. The new house must be residential. Vacant industrial or commercial land does not disqualify you. 3. Construction must finish within 3 years of the sale. It can even start before. 4. You must invest an amount equal to the gain, not necessarily the exact sale proceeds. Let's recap. A 26.77 crore rupee stock profit, 1 legal provision, Section 54F, 4 objections from the tax department, all overturned. Result, 0 tax, fully within the law. But here's the twist. The same rule that saved her 26 crore rupees has also been used to fake eligibility, and it got someone's exemption thrown out by the court. Next time, the gift that fooled no one. If this finally made sense of how the wealthy legally pay so little tax, please hit that subscribe button. It's completely free, and it's the single biggest way you help this channel grow and reach more people just starting out. Drop a like so others can find it, and tap the bell so the next episode comes straight to you. See you there.